Welcome back to the deep dive. If you've ever felt, just swamped by investing, trying to guess the next big stock or figure out all the market jargon well, we might just have the ultimate shortcut for you today.
Yeah, we're cracking open the world of index funds.
Exactly. Index funds. They're arguably one of the most powerful and successful ways to get diversified, low-cost investing with pretty reliable long-term growth.
Absolutely. Sophisticated investors often love them because, well, you're basically betting on the whole market doing well over time, rather than just one or two companies hitting it big.
Okay, so what's our mission for this deep dive then?
Well, first, we need to clearly define what these things are, then figure out why they become so dominant in finance. And maybe most importantly, we'll dive into some specific high-performing funds out there right now.
And we're really going to focus on performance, but also crucially cost, right?
Oh, absolutely. Cost is.
Yeah.
Well, it's maybe the single most important factor we'll talk about today.
Okay, let's start at scare one. When we say index fund, what are we actually buying? What is it?
It's actually simpler than it sounds. An index fund is just an investment product, could be a mutual fund, could be an ETF, an exchange-traded fund.
Right.
And its whole job is just to copy the performance of a specific list, a basket of stocks. We call that basket an index.
Like the S&P 500 everyone talks about.
Exactly like the S&P 500.
Yeah.
Think of it as passive investing. The managers aren't trying to be clever and pick winners. They're just following a recipe, a successful one, usually with minimal tinkering.
So, okay, why has this passive thing taken off so much? Why are people, especially folks, looking for long-term growth without all the hassle flocking to these?
Well, the first big reason is just history, the returns. I mean, sure, some active managers do beat the market sometimes.
Sometimes.
Yeah, sometimes. But the long-term average for a big index like the S&P 500, it's historically been around 10% a year. That's pretty attractive.
Especially when you think about how little effort it takes compared to stock picking.
Precisely, and that leads to the second huge advantage, diversification, right out of the box.
Ah, yeah. Meaning you're not putting all your eggs in one basket.
Exactly. With just one purchase, say, of an S&P 500 fund, boom, you own a tiny piece of hundreds of the biggest U.S. companies.
Across different industries.
Across everything, it spreads out your risk immediately. Trying to build that kind of portfolio yourself, buying individual stocks, it'd take forever and cost a fortune in commissions.
Okay, so diversification helps with risk. People sometimes say index funds are safe. Now, they're not like a savings account. Obviously, they go up and down.
Right, not guaranteed.
But how much safer are they, really? Could you lose everything?
That diversification makes a massive difference in risks. That's advantage number 3. For a well-diversified index fund like an S&P 500 one, to go to absolute zero.
Yeah.
I mean, every single one of those 500 companies would have to fail completely.
Yeah.
We're talking total economic meltdown scenario, not just a bad year.
Okay, so much less likely than one single company going bust.
Far less likely. They fluctuate, yes,
Yeah.
but much less violently than individual stocks usually do.
Yeah.
It's built-in risk reduction.
And finally, number 4, the reason we keep mentioning, cost. If there aren't managers actively trading all day, the fees should be lower. Yeah.
That's the theory, and thankfully it's mostly the reality. Cost, specifically the expense ratio, is so critical because it chips away at your returns every single year, whether the market's up or down.
Like a tiny little leak in your investment bucket.
Exactly. And the best index funds have expense ratios that are incredibly low. We're talking fractions of a percent, sometimes just a few dollars a year for every 10,000 you invest.
Wow.
And that low cost is a major reason why, over the long haul, these broad index funds have, frankly, crushed the majority of actively managed funds, which charge way more for often worse results.
Okay, this is making sense. So before we look at specific funds, maybe we should quickly touch on the main recipes they follow, the indexes themselves. What are the big ones we need to know?
Right, good idea.
Uh,
Because the index determines what you actually own. There are 4 main benchmarks everyone talks about.
let's start with the big one, the one you hear on the news every night.
That'd be the Standard & Poor's 500. The S&P 500. It tracks 500 of the largest U.S. companies. It's basically the go-to proxy for the health of the entire U.S. large-cap stock market.
Large cap meaning the biggest companies.
The biggest ones, yeah.
Okay, what about tech? If you want that kind of high-growth, tech-focused exposure.
You're probably looking at the NASDAQ. Often, funds track the NASDAQ 100 index.
NASDAQ 100.
Right. That's the 100 largest non-financial companies listed on the NASDAQ exchange. So think Apple, Microsoft, Amazon, Google, heavy on tech.
But less diversified than the S&P 500 because of that tech focus.
Definitely. It's more concentrated in one sector,
Right.
which can mean higher highs but also potentially lower lows, more volatile.
Got it. What about the Dow Jones? Everyone knows that name.
The Dow Jones Industrial Average, yeah.
Yeah.
It's historic, tracks 30 large established blue chip companies. But honestly, with only 30 stocks, it's not really the best snapshot of the overall market anymore compared to the S&P 500.
Interesting. Okay, and you mentioned diversification earlier. What about smaller companies? Not just the giants.
Good point. For that, you look at the Russell 2000 index.
Russell 2000.
Yeah, it tracks about 2,000 of the smallest publicly traded U.S. companies, small cap stocks. They can be riskier, but they also offer different growth potential, important for truly total market diversification.
Okay, now let's get into the nitty-gritty. The S&P 500 funds. If you have, say, 5 different funds all trying to do the exact same thing, track the S&P 500, their performance should be almost identical, right?
Pretty much, yeah. Barring tiny differences called tracking error.
So if the performance is the same, the only thing that matters for your long-term return is
The cost, the expense ratio. This is where the cost war really plays out. And the costs have gotten incredibly low.
razor thin.
Absolutely. Like the average expense ratio for S&P 500 funds has dropped significantly just in the last few years. Competition is fierce, which is great for you, the investor.
Okay, let's name some names. Who's leading this race to the bottom? Fidelity made waves with one, didn't they?
They certainly did. The Fidelity Zero Large Cap Index Fund, ticker FNILX,
Zero, as in free.
as in a 0% expense ratio. $0 per year for every $10,000 you invest. Pretty revolutionary.
How do they even do that?
Well, there's a slight technicality that doesn't officially track the S&P 500. It tracks Fidelity's own U.S. large cap index, which is designed to be virtually identical.
So they avoid paying licensing fees to S&P.
Exactly. And they pass that saving on. Its 5-year annualized return is right around 14.6%, very close to the S&P.
Okay, sticking with mutual funds for a second. Schwab's also known for low cost, right? SWP PPX.
Yep, the Schwab S&P 500 Index Fund, SWPPX. They are super investor friendly. This one does officially track the S&P 500, and its expense ratio is just 0.02%.
So $2 a year per 10,000 invested.
Tiny.
Incredibly tiny.
Yeah.
And its 5-year return, 14.8%, basically matching the index.
Now let's shift to ETFs, exchange-traded funds. These trade like stocks. Who are the big players tracking the S&P 500 here?
The giants are Vanguard and iShares. You've got the Vanguard S&P 500 ETF, ticker VOO.
VOO, got it.
And the iShares Core S&P 500 ETF, ticker IVV. IVV. Okay. How do they stack up?
There's essentially twins. Both track the S&P 500.
Yeah.
Both have the same extremely low expense ratio,
Yeah.
0.03%.
So $3 a year per 10,000.
Right. And both have identical 5-year returns of 14.8%.
Mm.
For most people looking for an S&P 500 ETF, you could almost flip a coin between VOO and IVV. They were both excellent choices.
Okay, so those set the benchmark for low-cost ETFs, but there's another really famous S&P 500 ETF, the oldest one, right? SPY.
Yes, SPY, the SPDR S&P 500 ETF Trust, the spider, it's the granddaddy, launched way back in 1993. Hugely popular, very liquid.
But, I sense a but.
But its expense ratio is significantly higher. It's 0.095%.
Okay, 0.095, that's $9.50 per 10,000. Still sounds small, but compared to VOO and IVV's $3.
It's more than 3 times the cost. And look, that difference, 0.065%, might seem like peanuts day to day. But if you invest, say, $100,000 over 20 or 30 years,
Yeah.
that tiny difference in fees compounds. You could be leaving thousands, maybe tens of thousands of dollars on the table just by holding the older, more expensive SPY instead of VOO or IVV.
Wow, okay. That really drives home why cost matters so much when the underlying investment is identical.
It's the only thing you can control, and it adds up massively over time.
All right, this is fascinating. But not everyone wants just the S&P 500, right? What about funds targeting, say, higher growth, even if it means less diversification? Or different parts of the market?
Absolutely. Let's look beyond the S&P. If you're chasing that higher growth, especially in tech, you look at funds tracking the NASDAQ 100.
Okay, the tap-heavy index we mentioned.
Right. But remember, you're trading some diversification for that potential extra performance. The big ETF here is the Invesco QQQ Trust, ticker QQQ.
The Qs. Heard of that one?
Yeah, very popular. It tracks those 100 largest non-financial companies on the NASDAQ. Its expense ratio is higher than the S&P funds at 0.20%.
So $20 per 10,000, noticeably more.
It is, but its performance has often justified it. The 5-year return is the highest on our list today at 15.3% annually, And according to Lipper data, QQQ was actually the top-performing large-cap growth fund for the 15 years ending December 2023.
So higher costs, but potentially higher returns if tech does well.
That's the trade-off. Now, just to show how much costs can vary even tracking the same index, there's a mutual fund called the Shelton NASDAQ Q100 Index Direct, ticker NSDX.
Okay.
Tracks the NASDAQ 100 just like QQQ, but its expense ratio, 0.51%.
Whoa, that's $51 per 10,000, more than double QQQ's fee.
Exactly. For the same index exposure, it just hammers home. You have to compare costs between different providers, even for the same index.
Message received. Okay, let's move away from large cap growth. How do we get exposure to those smaller companies we talked about, the Russell 2000?
Vanguard has an ETF for that. The Vanguard Russell 2000 ETF, ticker VTWO.
VTWO.
Tracks those 2,000 smallest public companies, gives you that small cap exposure. A cost is nice and low, 0.07%.
$7 per 10,000.
Right, but interestingly, look at the 5-year return, 10.1%. Noticeably lower than the large cap S&P 500 funds recently.
Yeah, so small caps haven't kept pace lately.
Not lately, no. They can be more volatile, and sometimes they lag, sometimes they lead. It shows why diversification across market caps can be useful.
Okay, so we've got S&P 500 for large caps, NASDAQ 100 for tech growth, Russell 2000 for small caps. What if someone just says, forget it, I want to own everything, the entire U.S. stock market?
There's a fund for that, too. The total market approach. A great example is the Vanguard Total Stock Market ETF, ticker VTI.
VTI. Total stock market. Makes sense.
Yep. It aims to cover basically the entire universe of publicly traded U.S. stocks, large, medium, and small companies across all sectors. Super diversified.
And the cost, knowing Vanguard.
Predictably low, 0.03%. Same as VOO.
$3 a year.
Right. And its 5-year return is a very solid 14.2%. For someone who just wants to buy the entire U.S. market in one click, VTI is a fantastic low-cost option.
Okay, this has been incredibly helpful. The case for index funds, especially low-cost ones, seems really strong. So for someone listening who's thinking, all right, I'm ready to do this, what are the actual steps? And maybe more importantly, what are the hidden traps to avoid?
Good questions. The process itself isn't too complicated, but you need to be deliberate. Let's break it down into maybe 3 steps.
Okay, step 1.
Step 1 is research and analysis, but not of individual stocks. Research the exposure you want. Ask yourself, am I focused just on the U.S. or do I want global exposure? Am I heavy on tech or do I want broader sectors like healthcare or financials? Am I aiming for high growth, maybe with small caps, or more stable blue chips?
And really read the fund's details.
Absolutely. Check the index it tracks, look at its top holdings. Sometimes the name of a fund can be a bit misleading, so make sure you know what's actually inside.
Okay, understand the exposure, step 2.
Step 2 is choosing the specific fund. We've already hammered home that expenses are critical. Compare those expense ratios relentlessly.
Right, but what else if 2 funds track the same index and have similar low costs?
Then you look at a couple other key things. First, taxes. This is a huge difference, especially between mutual funds and ETFs. If you're investing outside of a retirement account like a 401k or IRA.
How so?
Well, traditional mutual funds often have to distribute capital gains to shareholders at the end of the year. This happens when the manager sells stocks inside the fund that have gone up in value.
Okay.
The problem is you get hit with a tax bill for those gains, even if you never sold a single share of the mutual fund yourself. It's called a taxable distribution.
Wait, really? You get taxed just because the fund internally bought and sold stuff?
Yep. ETFs, because of how they're structured with creation and redemption units, are generally much more tax efficient. They usually don't stick you with those unexpected capital gains distributions. It can save you a lot in taxes over the years in a regular brokerage account.
That's a really important distinction. Okay, taxes. What else?
Investment minimums. Some mutual funds, especially older ones, might require you to invest, say, $3,000 or even $10,000 just to get started.
Ah, a barrier for new investors.
Can be. Most ETFs, on the other hand, trade like stocks. You can often buy just one share or even fractional shares through many brokers now for just a few dollars. Much more accessible.
Good point. Okay, so research exposure, compare funds, costs, taxes, minimums. Step 3.
Step 3 is just buy it. Purchase the fund.
How?
ETFs trade on stock exchanges, so you'll need a brokerage account to buy them. Mutual funds can sometimes be bought directly from the fund company, like Vanguard or Fidelity, or through a broker.
Any pitfalls here?
One big one to watch out for, mostly with mutual funds bought through certain advisors or brokers,
Sales loads. Sales loads. Sounds bad.
It is. It's basically a commission you pay up front, a front-end load, or sometimes when you sell, a back-end load. It can take a chunk, maybe 1%, 2%, even more, right off the top of your investment before it even starts working for you.
Yikes. How do you avoid those?
Easy. Stick with the big direct-to-investor fund families we've been talking about, Vanguard, Fidelity, Schwab. They typically offer no-load funds. Just be sure to check. Never pay a sales load if you don't have to. #outrag_outro.
Okay, let's try and wrap this up. If we boil it all down, what's the big takeaway for you, the listener?
I mean, the power of index funds is pretty clear, I think. You get incredible diversification, super low costs if you choose wisely, and broad ownership of the market. They're kind of designed for steady long-term success.
And that cost point, it seems like the absolute non-negotiable.
It really is. If you find two funds tracking the exact same index, S&P 500, NASDAQ 100, whatever, pick the cheaper one, period.
Yeah.
There's just no logical reason to pay more for the identical underlying investment. You're just giving away your future returns.
So assuming you're investing for the long haul, like decades is now generally a good time to buy these broad index funds.
Well, the general consensus among most financial experts is yes. If your time horizon is long, trying to perfectly time the market is usually a fool's errand. The market has historically trended upwards over long periods. Time in the market is usually more important than timing the market. That's how compounding really works its magic.
Right. But that brings up a tricky question, doesn't it? Especially lately. Market returns have been pretty strong, well above average in recent years. We hit a bunch of new all-time highs in 2024. Doesn't that make you nervous about putting new money in right at the top? Should you maybe wait for a dip?
The market timing temptation. It's so common. But honestly, almost all the evidence advises against it.
Why? It feels intuitive to wait if things seem high.
Because nobody can consistently predict the peaks and troughs. Studies have shown that if you miss just the best handful of days in the market over, say, a 20-year period, your overall return gets absolutely hammered. Those big up days often happen unexpectedly, sometimes right after big drops.
So trying to jump in and out is risky.
Extremely risky. The much more reliable path is just discipline. Keep investing regularly. Put money in consistently, maybe every month or every paycheck, regardless of whether the market is up or down that day.
That's dollar cost averaging, right?
Exactly. You automatically buy more shares when prices are lower and fewer shares when prices are higher. It smooths out your purchase price over time and reduces the risk of dumping all your money in right at a peak. That patient, steady discipline, that's probably your best friend for long-term investing success.
A great final thought. Discipline over timing. Thanks so much for breaking all this down.
My pleasure. It's a really important topic.